Crypto has created millionaires overnight, and some billionaires. But one story stands out. It's not just about coins, charts, or luck. It's about how one man played the game differently and won. This is the story of the crypto game Billionaire. But before the billions, let's rewind. The man behind the title The Crypto Game Billionaire isn't a household name yet, but in certain corners of the internet forums and telegram groups, his username alone sparks curiosity, admiration, and sometimes envy. His real name is Alex Tan. Born in 1987 in a working-class neighborhood outside of Singapore, no trust fund, no financial safety net. Just a kid with a second-hand computer and a relentless curiosity about how things worked. From a young age, Alex showed signs he didn't see the world like the most people. While other kids were glued to video games, Alex was in the back of the school library reading about game design, not playing them. By 13, he'd figured out how to jailbreak his phone and started helping classmates unlock their devices for lunch money. This wasn't just hustling, it was problem solving. He liked puzzles, systems, and finding shortcuts others missed. His first real exposure to finance came by accident. Around 16, he found a copy of Rich Dad Poor Dad at a flea market. The book didn't teach him to be rich overnight, but it planted one dangerous idea in his mind. Money moves when you learn the rules that the most people ignore. While his friends chased grades and careers, Alex started thinking about leverage, ownership, and systems. By the time he was 20, he was coding simple scripts for poker bots and writing plugins for MMO games. Nothing flashy, but it gave him two skills that would become critical later: understanding algorithms and reading market behavior. He didn't see these as separate worlds. In his mind, they were just different types of games, and he was learning how to win them. Still, none of this screamed future billionaire. He didn't drop out of college with a master plan. He didn't invent a startup or stumble into wealth. What he did have was a sharp eye for systems and a growing interest in how technology could be used not just to build products, but to move money. And one night, while reading a tech blog, he came across a strange word that most people in 2009 ignored: Bitcoin. He didn't grow up rich, but one thing changed everything. He wasn't looking for crypto, not really. He was just scrolling through an online tech forum one night in 2012, chasing a rabbit hole about decentralized systems. There was a thread titled "Bitcoin, the Future of Money," and it had hundreds of comments, half of them skeptical, the other half borderline obsessed. Something about it caught his attention. It wasn't the money talk at first, it was the idea. A system without banks, without borders, without needing permission. A digital currency that people control themselves. He kept reading. Posts linked to the original Bitcoin white paper, so he downloaded it. The writing was dry, but the concept clicked. Peer-to-peer electronic cash. That phrase stuck with him. He had always been curious about power. Who had it and who didn't? Bitcoin flipped that. He saw it as more than tech. It was a social shift. His reaction wasn't hype. He wasn't jumping up and down or tweeting about it. He was quiet. He watched. He listened. He read everything he could. Reddit, Bitcoin talk forums, early YouTube channels run by guys who looked like they mined coins from their basements. He wanted to understand not just what crypto was, but why it mattered. Then came the moment he bought in. February 2013. He was working a freelance coding gig that barely paid, but he set aside $300. Bitcoin was around $22 at the time. He bought a few and stored them on a clunky old wallet app that looked like it could crash at any second. It wasn't smooth, the process was frustrating. Exchanges were shady, UI was garbage, and nobody really knew what they were doing. But it felt like he was part of something underground, strange, and important. He didn't expect to get rich. That's not why he did it. It was about learning, about being early. If this thing failed, fine, he was ready to lose it all. But if it worked, he didn't even know what work meant yet. He just knew he had to be in. Looking back, he says that $300 was the best decision he ever made. Not because of the money, but because it pulled him into the game. It changed how he saw value, risk, and control. From that point forward, crypto wasn't just a side interest, it became the focus. Buying crypto is one thing, knowing what to do with it, that's where it got interesting. What set him apart wasn't just that he brought crypto early. It was how he played the game once he got in. While most newcomers were chasing hype or holding blindly, he treated it like a chessboard. Every coin, every token, every trade was a calculated move. From the start, he didn't buy into the idea of one coin to rule them all. While others bet everything on Bitcoin, he diversified. Yes, he believed in Bitcoin, but he saw Ethereum as a platform, not just as a coin. He understood what smart contracts could become, and he positioned himself there early, before it was popular, before it was safe. He also studied patterns, not just price charts but behavior. He watched how the market moved during certain announcements, how people reacted to FUD, and how hype built around coins with zero utility. That gave him an edge, not just in choosing what to buy, but when to buy and sell. He wasn't a gambler, he was a reader of momentum. In the early days, he played a mix of hodling and active trading. He held his core assets, Bitcoin, Ethereum, and a few long-term plays. But around those, he made aggressive short-term trades, especially during bull runs. When ICOs exploded in 2017, he didn't go all in. He watched, studied, and picked only a few to back. And when he did, he read the white papers like a VC investor, not a Reddit user. That attention to detail saved him from scams and gave him access to projects that would eventually grow 10 times or 50 times. But not every move was perfect. He once put a significant chunk into a now-dead altcoin that seemed to have a legit team and product. The community was strong, the code was open source, and there was early buzz, but it turned out the leadership fumbled funds, overpromised features, and the project collapsed. He lost over 6 figures in weeks. That mistake hurt, but it didn't stop him. He didn't panic sell. He studied what went wrong and adjusted. He learned fast. Every mistake turned into data. He started building a checklist before investing. Who's behind the coin? What problem does it solve? Is there actual development happening? Are the tokenomics solid? If any answer was vague, he passed. The discipline separated him from the herd. He also paid attention to regulatory shifts and tech infrastructure. He watched how wallets, exchanges, and bridges evolved. He avoided flashy projects without real backing. When DeFi began gaining traction, he was already ahead of the curve. He knew yield farming wouldn't last forever, but he used it while it did, pulling out profits before crashes hit. Above all, he thought long-term, while others bragged about 2 times or 3 times wins. He stayed quiet during 20x plays. His strategy wasn't about looking smart in Telegram groups. It was about stacking moves year after year and keeping a clear head when markets got noisy. He didn't just buy crypto. He studied it like a full-time job. Researched, tested, failed, pivoted, and scaled. And that's what made the difference. But smart moves only go so far without timing. It started with a coin that most people ignored. Not Bitcoin, not even Ethereum. Those were already catching mainstream attention. This was a low-cap altcoin buried under hype and noise. While most investors crashed trends, he looked deeper. He wasn't trying to get rich quicker. He was looking for cracks in the system, places where value hadn't been discovered yet. And that's how he found it. The project wasn't flashy. It didn't have celebrity endorsements or Super Bowl ads. But it had something better: strong fundamentals, an active developer community, and a real solution to a real problem in blockchain tech: scalability. He read the white paper front to back, dug through the GitHub repos, joined the Telegram group, and even spoke directly with one of the developers. While others laughed it off, he quietly started buying in, steadily over weeks. At first, nothing happened. Prices dipped, some early investors bailed, but he held, even doubled down. Then, months later, a massive partnership was announced. A top 5 crypto exchange listed the coin. Everything flipped. The coin surged 1200% in just a few days. Media outlets started talking. Influencers started hyping, but by then he was already holding a sizable bag, at prices 90% lower than the current peak. That moment changed everything. In a single week, his portfolio shot past $200 million. Over the next few months, that figure kept growing. By the time the bull run cooled off, he had crossed the $1 billion mark. Not in stock options or valuations. Real liquid crypto wealth. It wasn't just luck, it was timing, patience, and obsession with research. He didn't follow the herd. He got in before the herd even showed up. So why did others miss it? Because they were looking for shortcuts. They waited for hype to confirm value. He did the reverse. He confirmed the value before the hype. That's the difference between playing the game and understanding the game. He wasn't smarter than everyone else. He just played longer hours, asked better questions, and trusted his judgment more than Twitter threads and influencer tweets. That single bet set off a chain reaction. It gave him capital, credibility, and access. Suddenly, every project wanted him involved. VCs called, exchanges offered equity, founders asked for advice. He went from unknown Reddit user to a name whispered in every Telegram group. And while others scrambled to ride the next wave, he was already building the next one. After that, things exploded. After his big break, the numbers started climbing fast, faster than even he expected. What had once been a risky crypto bet turned into a launchpad. In just months, his portfolio grew from millions to hundreds of millions, and then into the billions. Most people would cash out, buy a yacht and disappear, but not him. He saw the wave coming and doubled down. Instead of walking away, he used his sudden wealth as fuel. He invested in blockchain startups that he believed in, not just for profit, but to push the technology forward. Some were tiny projects with a few developers and a dream. Others were big names that later dominated headlines. He wasn't just riding the crypto wave, he was shaping it. One of his smartest moves, diversifying. He knew crypto was volatile, so he started buying into Web3, decentralized finance, and even artificial intelligence. Wherever tech was heading, he tried to be one step ahead. He backed a decentralized gaming company that exploded in value when NFTs boomed. He put money into a crypto wallet app that eventually became a top player in the space. Then came the media. It started with blogs and crypto podcasts. But soon CNBC and Forbes came calling. He became the face of the crypto gold rush, a symbol of luck, risk, and a new kind of capitalism. With fame came upgrades, luxury homes, exotic cars, even a private island. But he didn't go full rock star. No flashy entourage, no scandals. Just hoodies, charts, and the occasional motivational quote. Some saw him as humble, others strategic. Either way, it worked. People trusted him. His tweets moved markets. When he backed a coin, the world noticed. Quietly, he mentored rising founders. No spotlight, just support. He knew what it felt like to be ignored, and now that he had influence, he used it. Critics still called him lucky or manipulative, but he kept going. Crypto gave me everything, but it can take it all too. He often said. His wealth grew and so did the pressure. Every move was watched, every word dissected. He wasn't just playing the game anymore, he was shaping it. But behind all the success, not everything was smooth. As the crypto game Billionaire's fortune grew, so did the scrutiny. With every headline calling him a genius or visionary, there were just as many calling him reckless, lucky, or even shady. The public's doubts weren't entirely baseless. Crypto had always walked a fine line between innovation and chaos. People wanted to know, was he just riding the wave or did he know something others didn't? The first big backlash came when one of the early coins he backed lost nearly 80% of its value. Thousands had followed his head and invested, expecting similar success. When the crash hit, angry investors flooded social media, blaming him for hyping what they now saw as a worthless asset. He hadn't told anyone to buy it, but his influence was powerful, and people took his moves as signals. Suddenly, the same online communities that once praised him started calling him a fraud, a manipulator, or worse. Then came the regulatory heat. One of the crypto exchanges he had supported early on was accused of manipulating volume and misleading users. Though he wasn't directly involved in day-to-day operations, his public association with the company brought his name into the mess, lumped him into the scandal without clear evidence, using vague connections to stir controversy. It wasn't the first time guilt by association would try to strain his name. Adding to the pressure were whispers about insider trading. In a space where coins could jump 10 times a day, people speculated about how he always seemed one step ahead. Critics suggested he had inside info from developers or project teams. But again, no proof surfaced. It was more about perception than fact. Even with all this, he never responded emotionally or lashed out. His strategy was simple: stay focused, stay quiet, and keep building. He didn't get into Twitter wars or write defensive blog posts. Instead, he redirected the attention by backing new projects, funding blockchain education, and speaking at global conferences about crypto's future, not his personal wins. The mental toll was real. Friends say he started sleeping less, working more, obsessing over transparency. The fear of being labeled as a scammer after building everything with what he believed was good intent pushed him harder than ever. But in the end, every challenge he faced only sharpened his approach. He became more careful, more selective, more strategic. And while the noise around him never fully went away, it never stopped him either. Still, he didn't back down. The crypto game Billionaire didn't just stack wealth, he reshaped how people think about digital money. His name became part of the conversation whenever someone talked about innovation, disruption, or risk-taking in finance. Whether through direct investment, public appearances, or behind-the-scenes influence, he left a mark that goes beyond price charts and token lists. He backed early-stage blockchain projects that others ignored. Some failed, but several became major players in the space, used by millions, referenced by developers, and adopted by institutions. He didn't just buy coin. He fueled ecosystems. That's a big reason why he gained respect from developers who often view investors with suspicion. They saw he wasn't just chasing profits. He understood the tech and often asked the right questions. Among investors, the story became legend. Newcomers studied his moves the way athletes study game tape. They quoted his tweets, they watched old interviews. Some tried to copy him exactly, usually without success, but others learned a deeper lesson, that timing, research, and guts matter more than hype. His influence pushed retail investors to dig deeper and rethink long-term, which changed the tone of crypto discourse online. Public perception of crypto has always swung wildly, from genius-level innovation to Ponzi schemes paranoia. But his story helped balance that narrative. When traditional media covered him, it wasn't just about how rich he got, but how he got there. That created space for more serious conversations around blockchain, decentralization, and financial access. His background and rise made it easier for skeptics to take crypto seriously, even if they didn't fully buy in. Of course, not everyone agrees on his impact. Critics argue that his wealth came from speculative mania and that he benefited from timing more than strategy. Others say he got lucky and that stories like his create false hope. But even they admit he moved markets and people listened when he spoke. Now he's seen as a sort of icon. Not untouchable or flawless, but someone who played the game at the highest level and survived. Some say he's the crypto world's version of a rock star. Others call him the first digital era tycoon who truly understood both culture and code. Whatever the label, his legacy is secure. So what can we learn from this story? And what would you do with $1 billion in crypto? Share your thoughts in the comments below. And if you enjoyed this story, don't forget to like, share, and subscribe.